Hello and welcome to this session on bond calculations. In this session you will learn about rates associated to the bond, relation between interest and bond price, relation between yield and bond price, current yield and yield to maturity, accrued interest and clean and dirty price. In this session we will be closely assessing the impact of rates on bonds performance. Bonds have four important components which are principal, coupon, maturity and price. All of these impact the performance of a bond. Bonds are divided into two types based on their rates. The two types of bonds are fixed rate bonds and floating rate notes. Let us look at the first type of bond, which is fixed rate bond. A fixed rate bond is a long-term debt paper that carries a predetermined interest rate. This interest rate is usually displayed on bond as you can see on screen. The interest rate known as coupon rate and interest is payable at a specified date before bond maturity. Due to the fixed coupon, the market value of a fixed rate bond is susceptible to fluctuation in interest rate and therefore has a significant amount of interest rate risk. That being said, the fixed rate bond, although it is a conservative investment, is highly susceptible to loss in value due to inflation. The fixed rate bond's long maturity schedule and predetermined coupon rate offers an investor a solidified return while leaving the individual exposed to rise in consumer price index and decrease in their purchasing power. Moving on to floating rate notes. Floating rate notes or FRNs are bonds that have variable coupon equal to money market reference rate like Libor or federal funds rate plus a quoted spread. The spread is a rate that remains constant. Almost all FRNs have quarterly coupons, that is, they pay out interest every 3 months. At beginning of each coupon period, the coupon is calculated by taking the fixing of the reference rate for that day and adding the spread. A typical coupon would be 3 months USD Libor plus 0.2%. So what's Libor? Libor is short form of London Interbank Offer Rate. This is a benchmark rate used for various borrowing and lending in financial market, and it acts as a measuring tool for the performance of bonds in the market. Most of the bonds will always want to pay a higher coupon as against existing interest rate in market. This is also known as a spread. The relationship of market interest rate and price of the bond will be discussed further. But first, let us understand the impact of Libor. For an investor who plans to hold a fixed income security to maturity, the change in its price before maturity is not of much concern or risk. However, for an investor who may have to sell the fixed income security before the maturity date, an increase in interest rates will mean the realization of capital loss. This risk is referred to as market risk or interest rate risk, which is by far the biggest risk faced by an investor in the fixed income market. Libor rate fluctuation has an impact on performance of the bond, which is actually basically measured using yield and its relationship with bond price. Libor is published for major currencies on a daily basis in order to facilitate borrowing and lending. In this table, you'll see the Libor rates currently existing in market for Euro, Japanese yen, US dollars, Swiss francs and pounds. The bond buyer 20 bond index is a barometer for yields on tax-free bonds issued by state government and local municipalities. The Fannie Mae 30-year mortgage commitment for delivery within 60 days help mortgage lender determine what rates to charge on 30-year fixed rates so that are to be sold to Fannie Mae within the next 60 days. The Libor rates are benchmark interest rates for many adjustable rate mortgages, business loans and financial instruments traded on global financial markets. Moving on to the rates associated with the bond. The rate at which a bond is issued is an interplay between two factors, that is, market interest rate and inflation rate. Inflation rate is an important measure of economic performance. Now let's understand how this impacts bonds performance. To curb high inflationary scenario in economic central banks will increase the repo rate and hence borrowing of commercial banks will become expensive. Hence, commercial banks will try to borrow money from market players and investors, and to make borrowing lucrative, they will increase the rates on deposits. Which means now interest rate on bank deposit will be higher than bond coupon, and debt investors' favored choice will be investment in bank deposit. This is the risk that has a major impact on bond performance. Bonds can be issued at a discount, at a par, or at a premium. First is at a discount. If the coupon rate is less than market rate, then the bond is issued at discount. Next is at par. If the coupon rate is equal to the market rate, then the bond is issued at par. And last we have at premium. If coupon rate is greater than the market rate, then bond issued is at premium. Let's understand the impact of interest rate on price of the bond. The behavior of interest rate is single most important force in the bond market. Interest rates and bond prices move in opposite directions. So when interest rates rise, bond prices fall and vice versa. Let's take a bearish bullish example to understand yield to maturity. Bond markets are bullish when interest rates are low or falling, whereas bond markets are bearish when interest rates are high or rising. Let's understand by taking an example. You have purchased a government bond that has been issued with following details. 1. Issued on 1st January 2015. Second, maturity is 5 years. Next, face value is $1,000. Lastly, coupon rate is 6% payable semi-annually, which basically means 3% will be paid twice a year. This is imperative to know that semi-annually it is just the frequency and bond will only pay 6% annually as coupon rate. Scenario 1 is, for the same amount of investment in bank deposit, the interest earned is 8%. Isn't bank deposit a better investment opportunity than investing in bond? The answer is obviously yes. Now if you try and sell this bond in market, the potential investors will not be willing to buy a bond at $1,000 as new bonds are issued that will give them higher return or will invest with banks as fixed deposits. Hence, what is the component with which issuer can work in order to make the bonds lucrative? After that, we have scenario 2. On the other hand, the interest rate in the markets go down to 4%, meaning banks are offering 4% on deposit with them. As a potential investor, where you will be willing to invest? Now, this is the time answer will be bonds. Will you want to sell the bond by altering which component? The answer for both the above question is principal. So, if the issued bond can provide a return of 8%, investors would be interested in buying the bond. So, the bank deposit would give them $80 in interest on investment of $1,000, whereas the same amount bond would only give them $60. The difference of $20 has been taken care by the issuer. In this case, issuer reduces the price of the bond to $980, which basically means the bond is costing $1,000 can be bought only for $980. But it is not a zero coupon bond. Be mindful that this bond has a coupon component. Issuer is just reducing the price of the bond, but coupon will still be paid on principal of $1,000, which means investor would receive $60 as return from the bond and also save $20 by purchasing the bond for lesser value. In total, investor earns $80, which is equivalent to bank deposit. Therefore, interest rate and bond price are inversely proportional. The current yield is simply the coupon of bond divided by the price. This measure looks at current price of a bond instead of its face value and represents the return an investor would expect if he or she purchased the bond and held it for a year. This measure is not an accurate reflection of actual return that an investor will receive in all cases, because bond and stock prices are constantly changing due to market factors. The current yield can be useful in obtaining a general idea of the size of the coupon on a bond relative to another, but it has nothing to do with true earnings potential and total return of a bond. The current yield focuses on current income, ignoring the capital gain component of bond returns. Moving on to the correlation between the yield and bond price. Yield refers to the rate of return which changes inversely with price. Yield is calculated as the coupon divided by the market price is multiplied by 100. Let us look at scenario 1. If the coupon is $100 and the market price is $1,000, the yield will be 100 divided by 1000 multiplied by 100, which will result in 10%. Moving on to scenario 2. If the coupon is $100 and the market price is $800, then the yield will be 100 divided by 800 multiplied by 100, which is equal to 12.5%. Next we see is scenario 3. If the coupon is $100 and the market price is $1,200, then the yield will be calculated as 100 divided by 1200 multiplied by 100, which is equal to 8.33%. In all three scenarios, what we notice is that in case price of the bond goes down, the yield goes up. That's because the coupon of a bond is always paid on principal amount that the bond was issued in market, irrespective of its current trading price. So ideally in scenario 2, the investor is purchasing a bond worth $1,000 for $800 but continues to receive the coupon amount of $100, which means total earning is equal to $300, $200 plus $100, as against scenario 3 in which total earning is a loss of $100. Hence, we can now establish that yield is inversely proportional to the price of the bond. From the table shown on the screen, we can deduce that the interest rate and yield are directly proportional to each other. The given chart also shows the performance of a bond in European market against existing Libor rates. As you can see, when interest rate goes up, the price of security goes down. As the result, the yield on securities goes up, which leads to a bearish market. Conversely, if the interest rate goes down, the price goes up. The yield goes down and resultant market is bullish. Next, we will distinguish between coupon and yield. Coupon is return on bond. Yield is return percentage based on the price on which bond was purchased. The coupon is fixed and never changes. On the other hand, yield changes based on current market price of the bond. Yield refers to total rate of return on the bond. In other words, yield to maturity is rate of return anticipated on a bond if it is held until the date of maturity. Yield to maturity is actual yield or return that an investor would receive over the life of a bond if the bond were held until maturity. Yield to maturity is first number bond managers take into account while considering fixed income investment. Besides being an accurate value measurement tool, yield to maturity also makes comparisons of various bond offerings easier by presenting a common measurement. Following are certain assumptions with regard to yield to maturity. That the intermediate cash flows to investors can be reinvested at a rate equal to the yield to maturity. It is also assumed that investors hold the bond until maturity. Hence, yield to maturity allows international traders to determine profit and loss on their bond holding. Yield to maturity is interest rate an investor would earn by investing every coupon payment from the bond at a constant interest rate until bond's maturity date. The present value of all these future cash flows equal to bond's market price. The yield to maturity is calculated using a formula which is shown on screen. It is calculated as coupon plus the face value minus the price divided by years to maturity. This is again divided by face value plus price upon 2. Solving the equation by hand requires the understanding between a bond's price and its yield. The interest rate is equal to coupon rate when the bond is priced at par. A bond priced above par, that is premium bond, has a coupon rate higher than the interest rate. And a bond priced below par has a coupon rate lower than the interest rate. So if an investor was calculating yield to maturity on bond priced below par, that is a discounted bond, he would solve the equation by plugging in various annual interest rates that were higher than the coupon rate until he found a bond price close to the price of the bond he was holding. Let's take an example. Shown on the screen are various parameters needed to calculate yield to maturity. Here, the coupon rate is 7.5% and required rate is 8.5%. So if a trader purchases a bond for $1,200 and holds it till maturity, his total return on investment will be 12.76%. The call premium is amount above the value at maturity that issuer must pay to the bondholder, because if they are calling the bond before maturity, then issuer will sell it back only at a premium. Moving further, let's differentiate current yield and yield to maturity. The current yield indicates the return on bond based on its current market value, while on the other hand, the yield to maturity is an anticipated rate of return associated with bonds till maturity. If a bond is bought at a discount of face value, the yield to maturity would be higher than the rate of current yield as the discount raises on the yield. On the other hand, if a premium is paid for a bond, the yield to maturity will be less than the current yield. Moving on to day count convention. The day count convention determines how interest is calculated between coupon payments on financial transactions or investments. The conventions vary depending on market type, location, and the currency. DCCs are primarily used to calculate the number of days in calculation of accrued interest. An important point to remember is that the number of days is calculated from the last coupon payment date. Let us focus on types of business day count convention. First is actual 360. This DCC assumes that the actual number of days elapsed between 2 days is divided by 360. The year is assumed to have 360 days. Next is actual 365. The actual 365 DCC assumes that the actual number of days elapsed between 2 dates is divided by 365. The year is assumed to have 365 days. Moving on to 30 by 360. A 30 by 360 day count convention assumes there are 30 days in a month and 360 days in a year. That is, a year comprises of 360 days. Lastly, we have actual by actual DCC. An actual by actual DCC convention uses the actual number of days in a month and a year for a given interest period. The US government bonds usually have actual 365 day count convention. Also, we can now use DCC to calculate accrued interest. This is a screenshot of a typical bond trading platform. The DCC is an important parameter that needs to be captured by booking of the trade. It enables you to calculate the accrued interest and give us the dirty price of a bond. On the next coupon pay date, that is 30 June, the company will pay you the coupon for 6 months, while the bond seller will receive nothing since he has sold the bond in between the cycle. In other words, the seller has accrued or earned but not received the coupons from last coupon payment date. So shouldn't you compensate the seller for holding the bond from 1st January till March 7? Hence, while purchasing the bond, you will compensate the seller by paying him the accrued interest. Moving on to accrued interest. Let's say you see a bond in market with following characteristics. The issue date of bond is 1st January 2014. Coupons are semi-annually issued at the rate of 5%. The face value of bond is $15,000 and the fair value is 101%. You decide to purchase it on 8th March 2015. Now the bond seller has held the bond from 1st January to 7th March. You will hold the bond from 8th March to 30th June. Now let us understand the formula to calculate accrued interest. The formula is face value multiplied by the percentage of coupon multiplied again by the DCC. Accrued interest for each DCC as of 8 March 2015 is given on screen. Actual by 360 would be $137.50. Actual by 365 would be $135.61. 30 by 360 would be $139.58. And finally, actual by actual would be $135.61. Moving on to the dirty price and clean price. The price which the bond buyer pays the bond seller in secondary market, including accrued interest, is known as dirty price. This is to be compared with the clean price, which is the market value of the bond which the buyer is willing to pay to the seller. The clean price excludes accrued interest. When bond prices are quoted on Bloomberg Terminal, Reuters or FactSet are quoted using the clean price. The clean price is mostly quoted in US bond markets. The dirty price is mostly quoted in European bond markets. In simple terms, if seller of the bond demands the already accrued interest to be paid on trade date itself, then the bond is said to be having traded at dirty price. If the bond seller does not include accrued interest, then the bond is said to be trading at a clean price. Now, let us look at the calculation of dirty price. Using the previous example, let us now calculate the dirty price. The price for each DCC is shown on screen. So the clean price is $15,150 and we have already calculated the accrued interest as $137.50. Hence the dirty price will be $15,287.50 if the DCCE is used by actual by 360. Simultaneously, the dirty price using the other DCC methods are calculated. We have covered rate associated with bonds as well as key terms like current and yield to maturity. With this, we reach the end of this session on bonds. In the next session, we will cover bond trading. Thank you and goodbye.